Welcome to Opening Bid. I'm Seana Smith in for Brian Sazzi. It is a massive week for the markets. We have stocks hovering near all-time highs. And of course, the big focus for investors is the Fed rate cut. And at the forefront of investors' minds right now is what ultimately the implications for the broader markets, what it's going to tell us, or the influence it's going to have on market leadership. So here to answer those questions and much, much more, I want to bring in our guest here for today. We have Dan Niles. Dan, it's great to have you here, founder and portfolio manager of Niles Investment Management. Dan, you're the perfect person to talk to about this because here we are sitting here today. We have markets at record highs, of course, in anticipation of a Fed rate cut. I'm curious just from your perspective, the implications of this for the market and ultimately what this is going to signal here for investors.
So with regards to the Fed, I really don't think it matters other than for a day whether they cut 25 basis points or 50 basis points, because I think we all know they're going to cut. They're going to cut at least 3 to 4 times, maybe 5 times before the end of this year. And unlike prior cuts, where they were dealing with either COVID or the global financial crisis, or before that, the tech bubble, this time the Fed's able to cut to try to ensure a soft landing rather than trying to deal with a crisis. So in that scenario, there's this old saying, don't fight the Fed. And I think that's appropriate today as well. And if we do get a soft landing, it'll be, the first time really since the mid 90s when the Fed was able to engineer that. And right now it looks, for a lot of different factors, which we can get into, that's what we're probably going to get is a soft landing.
Yeah, Dan, talk to me about some of those factors, just why maybe you are a bit more confident that maybe we are going to see that soft landing.
Well, I think the thing I've used from the very beginning is job openings versus number of people unemployed. And this is why all the way back in 2021, when the Fed was saying it was transitory, we were saying there's no way this is transitory because you had twice as many job openings as people unemployed. And in that scenario, which by the way, in a normal healthy economy, you typically have less job openings than people unemployed. So to have 2 times as many, for me, I was like, inflation is going to stay really high because the US is a services-led economy. If you look at it today, you've still got more job openings than people unemployed. You've got GDP growth that's around 3% or so, and unemployment on an absolute basis, it may be near a 3-year high, but it's still only at about 4.2%. And on top of this, you're going to probably get 100 basis points, let's say, of rate cuts between now and year end. And you've got inflation sitting right around, let's say, 2.5 to 3. The Fed's sitting up at 5.25 to 5.5. And so they can cut rates pretty aggressively to get it down to neutral, which is, right above wherever inflation is sitting. So I think when you look at it from that context, that's why I feel like we're going to get a soft landing this year.
So Dan, given that and given the fact that we are expecting to see rate cuts, you mentioned the fact that many are forecasting consensus seems to be 100 basis points of cuts here before the end of the year. What does that then tell us about market leadership? Because certainly we have seen this shift outside of the Mag 7. Does that sort of then reinforce that rotation that we've started to see?
Yeah, so I started writing, I think back in July 11th, about the fact that I thought there was a rising mismatch between the amount of CapEx spent on AI and the returns you were seeing on it, and the fact that I was looking outside of tech for leadership, and specifically areas that were going to benefit from rate cuts is where I was looking. So consumer staples, utilities, the telecom services companies, etc., because those are typically the names that do well. And if you look at what's gone on in the third quarter, that's exactly what's happened. And putting it more specifically, the S&P coming into today was about 1% from its all-time record high. But the Mag 7 were down 6% from that level of July 16th. But the equal weighted S&P was actually at a new all-time record high, up actually 3% from where it was on July 16th. And as you and I are speaking, the market actually hit an intraday high earlier today. I continue to believe that the Magnificent Seven in tech in general is not going to be what leads the market higher, but in fact, these other areas that benefit from rate cuts.
Yeah, and I guess, Dan, more specifically, what do you see as those areas that are going to benefit? Because as we have seen this rotation, just in terms of maybe the outperformance most recently, we have seen more money allocated towards real estate, utilities, consumer staples, some of those more defensive plays areas of the market. Are those areas that look attractive?
Yeah, those are the areas that, we've written about. That's where we're looking to put money to work. And quite honestly, for a lot of tech, we're looking at some of those names more on the short side than on the long side, which we've talked about before as well.
Yeah, so Dan, let's talk a little bit about technology because I know you're seeing some investment opportunities elsewhere, but a longtime tech investor, just what do you view, or what is your current view of the valuation debate right now, conversations surrounding the Mag 7 and maybe some of the pressure that we could likely see as maybe that rotation picks up?
Yeah, so I'll just go through them quickly. So if you look at the Mag 7 and go through each individual one, Meta continues to be our favorite because they're really using AI the best. And what I mean by that is they beat revenues and earnings per share for the June quarter, but they also had the forward revenues and earnings per share go up, even though they were investing more in AI. Now, if you look at some of the other names, the hyperscalers as they're known, if you look at Microsoft, Google, or Amazon, all three of them had their forward revenue estimates for the September quarter get cut, even though they're investing more in AI. So there's sort of this theme of, oh, you invest all this money in AI and you're going to get this immediate payback. And in fact, the numbers are going down while the CapEx is going up for a lot of these players. And so you got to keep that in the back of your mind. If you go to, obviously Tesla, which is in there, they've got really aggressive price competition coming from China. So, and with the multiple where it's sitting at 100 times, it's really hard to get that excited about the name. And with Apple, I was a big believer that AI on the smartphones would lead to a pretty solid upgrade cycle. Unfortunately, what you've seen is that, at least based on very early preliminary data, it looks like instead of this driving iPhone sales up about 10% year over year, in fact, it looks like, if the numbers are accurate, that they might be down 10% year over year, which would be really problematic because Apple, amongst the Magnificent Seven, has really had the worst revenue growth over the last 3 years, and the only reason the stock's done well is the multiples kept expanding. And so you've got a low 30 PE now for Apple, despite the fact that they grew revenues 2% 2 years ago, 0% a year ago, and this year, right now, it's forecasted at only 4%. And so it turns out that AI, for whatever reasons, maybe it's because the geographic rollout to China is only coming next year, or the consumer is in tougher shape than what we think, who knows, or the carriers aren't offering any more aggressive promotions than they were a year ago. Whatever the reason, right now at least, it doesn't look like demand is what we all thought it would be, and the valuation's high. And so, could that end up being another problem through year end? I think over the longer term, it's still going to drive an upgrade cycle, but you have to be flexible in your thinking and admit when, you're potentially wrong.
Yeah, so then, Dad, I guess that begs the question, is the upgrade cycle, when we will see maybe a substantial uptick, is that then likely going to be pushed out given all that uncertainty that maybe you're outlining right now?
Yeah, I mean, and I think that's the right way to think about it. Like, investing is all about, you have a thesis of what you think the future will look like, and then ultimately you have to reconcile with that with the facts. And the valuation kind of gives you the envelope of safety, as I like to think about it. And when you've got the S&P at 24 times, Apple PE in the low 30 times, and it's run up so much because we all thought there was going to be a nice upgrade cycle driven by AI, and it's not happening, you could have a really big problem on the other side of this as the multiple gets back to more reasonable levels. And by that, what I mean is, if you look at a Facebook, for example, it's trading at a market multiple, even though it's growing much faster than the market on both revenues and EPS. So why should Apple get a huge premium to where the market is if, in fact, this AI, driven iPhone cycle really doesn't seem to spur upgrades? My belief, though, is there's sort of this saying that, technology gets overhyped short term, underhyped long term. And I think that's probably the case right now, where because you have this staggered rollout of, you're getting some of the AI features first in the US, then China gets it next year and some of the other regions, that may be actually prolonging this. So it's not going to be a sharp up, but hopefully it's pretty steady over time, because I really like using the AI features that I do right now on my PC, because I think it really does improve my productivity. And I think consumers, as they use it more and more, will find that as well. And don't forget, AI is as dumb as it's ever going to be today. It's just going to keep getting smarter and smarter and smarter. And so what you can use it for is going to keep improving. And so a year from now, the capabilities will be so much better than they are today. I think consumers will ultimately end up adopting this in a big way.
Dan, that's a great point. I want you to hang tight real quick. We're going to take a quick break, and we'll be right back for more insight. We're back with Dan Niles, founder and portfolio manager of Niles Investment Management. And Dan, I want to pick up on your last point there, just in terms of where Apple stands in the AI race. And I bring it up in that framing because I think largely ahead of the most recent announcement that we got on some of their AI capabilities and features that are going to be included in their newest products, there was a sentiment out there that maybe Apple is too late or is late to the AI game. Do you find any truth to that, or were some of those fears just a bit overblown?
No, that's completely true. Apple is late. But Apple has a tendency of always being late, but then they tend to, because they have such a massive platform, and if you think about it, you've got about 1.2 billion smartphones worldwide in people's hands. Less than 10% of them can run the new AI features. And the last big upgrade was during COVID, because we're all stuck at home and we're all trying to figure out how to work from home and stay in touch with people from home. And so you had this massive upgrade cycle. But when was that? Well, that was back in 2020. Normal upgrade cycle is usually like 4 to 5 years, and people then turn over their phones. And if you have a reason to buy a new phone, and as we talked about earlier in the interview, GDP growth is still solid at 3%. People still have jobs with unemployment down at 4.2, and the stock market's going up. Real estate prices have started to go up again. All of this, plus Fed rate cuts coming, is good for how well the consumer feels. And so it's likely that, will they upgrade a phone that they last upgraded during COVID? Yeah, probably. But it looks like the consumer is saying, well, I may not need to rush out and buy one, today. And so that's the way I kind of think about this at this point. And so could Apple go down in the near term? Yeah, absolutely. As we talked about, the valuation's kind of high. But I think over the longer term, as we get into next year and, the AI feature is getting more compelling and it being rolled out everywhere across the globe, then I think you should see a longer upcycle versus a sharper upcycle, which is what I think most of us were initially anticipating.
Dave, let's take a step back and talk a little bit more just about the broader AI landscape right now, the investing landscape. And I bring that up because one of the common themes amongst earnings calls this most recent earnings season has been maybe it's more of a risk to underinvest in AI right now than overinvest. And we heard that from the CEOs of Google, Microsoft, Meta, just to name a few. What does that signal to you, I guess, just in terms of that future investment? And is that at all a risk of stalling out? And then, of course, the risk that then poses to some of these valuations, going back to our earlier conversation.
When you've got CEOs saying that, what that tells me is that they're already overinvesting.
Yeah.
So the fact that, because as I said earlier, Microsoft, Google, Amazon, September quarter revenues went down after they all reported, even though the CapEx that they're spending on AI went up. Now, there's a good reason for it. There's only one guy on the planet that's able to really provide the chips they all want, and that happens to be NVIDIA. And NVIDIA's newest chip, Blackwell's a little delayed coming out. I think once that comes out, you're going to see these companies sit and digest. And what I mean by that is, think back to COVID. So NVIDIA's revenues prior to COVID were actually down year over year. Then COVID hits and the revenues accelerate a lot. And then on the other side of that, so December quarter or the fourth quarter of 2021, revenues were up over 50% year over year. The December quarter of 2022, the revenues at NVIDIA were down over 20% year over year. And it's from the same group of customers. It's Amazon, it's Google, it's Microsoft. So you've already seen this happen once before. So now you've got a similar situation where revenue growth over the last 2 calendar years, last year and this year, is going to be up over 100% year over year at NVIDIA. But as we talked about earlier, the revenue forecasts are actually coming down. And so I think when you get into next year, when NVIDIA has shipped the Blackwell chips to their customers, they all have it, and they don't feel like they're all scrambling to get these, which right now they do, by the way, that you're going to go through this digestion phase, much like you saw after you went through that initial ramp up during COVID. But to be clear, and I've said this multiple times, I think you've got several more years of AI investment before you hit sort of a saturation or more maturing of the AI landscape. And I think you'll see NVIDIA's revenues double over the next several years, and I think you'll see the stock double over the next several years. But that does not mean that, much like what you saw after COVID, when the revenues went from up over 50% to down over 20%, and the stock went down 66% from peak to trough, that you're not going to see something similar on your way to much higher levels.
Dan, what would trigger some of that short-term pain then again? I guess in terms of the catalyst then to the downside, what investors need to be aware of, obviously any sort of developments to the downside or negative side about Blackwell chips would obviously be viewed as a huge headwind here to NVIDIA in the short term. But is it more of a sentiment shift? What do you think is going to drive then that volatility?
Actually, the exact opposite. I think it's when NVIDIA starts to ship Blackwell in volume and the customers get what they want, then they can go ahead and say, okay, I've gotten what I needed. Now I can go ahead and digest this. That's going to be the issue. Because, as I said earlier, investors are starting to demand that companies have a return on investment. So think about it this way. We said earlier the S&P 500 is 1% from its all-time record high coming into today, Tuesday. But the Magnificent Seven are down 6% since July 16th, when the S&P last hit an all-time record high, but the equal-weighted S&P is up 3%. Even if you look at when they reported results, when the Magnificent Seven reported March quarter results, the stocks the next day on average were up 4%. When they reported the June quarter results, the stocks on average were down 4%, which tells you that things have already started to change. And so some of this is just time. It's like anything else. You invest a lot over a long period of time. And as I said earlier, NVIDIA's revenues were up over 100% year over year last year. They're going to be up over 100% year over year this year. But the customers, at a certain point, if their revenues start to actually turn over and go down, they're going to need to see some return on that, and investors are demanding to see that. And so it's just more of a time thing, and Blackwell shipping enough volume that the customers, the big hyperscalers, feel satisfied for it. Meta's in a different situation, as I said earlier, because they are actually seeing return on deploying those chips to improve their own business. These other customers are really having people come to them and say, hey, I want to use Amazon Web Services or Google Cloud or Microsoft Azure to run my AI stuff. Meta's using it internally to ramp their business up more than anything else. And that's the differentiation to some degree between.
Dan, when we talk about increased adoption, maybe saturation eventually here, but that's going to happen right when we see increased competition, more competitors enter the landscape. And I bring that up just in terms of pricing power right now, because that has really been the focus surrounding NVIDIA's current valuation and kind of maybe the growth that we will then likely see over the next several quarters. How do you see the effect of pricing power playing out right now?
That is an excellent question, Seana, because here's the big thing that people are forgetting. The cost to generate results, or call it a token, or however you want to think about it, is growing down astronomically over time. And so I've seen some estimations that relative to a year ago, the cost to produce a token is down anywhere between 10 to 20, or it's 1/10 or 1/20th of the cost. And so what that means is that if you are an AI player, you can now you're going to charge 1/10 of what you were able to charge to generate a token as you were a year ago, which means the volume of what you have to generate obviously has got to be up over 10x to offset the 1/10 reduction in the cost to generate. And that's part of the issue of what's going on. And when you have somebody like a Meta, which is open sourcing Llama 3, which is a free open source AI engine that customers can then go out and use, that puts incredible pricing pressure on the whole landscape because free is pretty cheap. And so that's what you're competing against. And by the way, a lot of times free is not good. In this case, from everything I've heard in the industry, Meta's Llama product is incredibly good, and a lot of companies are adopting it, which puts pricing pressure on all of those that actually have to charge people to sustain their business models. And so that's another issue around if your cash flow is getting more negative because what you can charge customers is going down, but what you're having to spend to train these models keeps going up, that at some point comes to a head. And what I would remind people is we've been through these sort of incredible life-changing technologies before, whether it's the microprocessor or the internet most recently to most people. But don't forget, NASDAQ went down 78% from peak to trough from 2000, over a 2.5 year period of time to the August or so period in 2002. And it was just crushing. It was brutal. And so that's what I'm trying to say is that it doesn't mean you're not going to go through those periods right now. And so those are some of the things I'm thinking about, despite, everything you hear about. I mean, and I'm clearly in the minority because most people are going, hey, what's risk is underinvesting versus overinvesting. But I've been doing this long enough to find out what happens when you overinvest for a long period of time.
Dan, we only have about 30 seconds here, but I want to leave it on. What is the number one thing or piece of advice you would give investors right now, given where we are in the AI investment cycle and given the fact that there is so much uncertainty, at least here over the coming quarters?
Well, I think the thing, I always go back to something from Charles Darwin, right? It's not the strongest of the species or the smartest of the species that survives. It's the one most adaptable to change. The internet build out, if you take Netscape's launch at the end of '94, it took about 6 years for that to hit its peak. Cisco's revenues didn't have a down sequential quarter, and there were some acquisitions in there, but to oversimplify, it didn't have a down sequential quarter for about 6 years. The stock went on a roller coaster ride during those 6 years, but ultimately ended up 4,000% from the end of '94 to its peak. And so I think with AI, when you do get a digestion phase, you'll have a lot of people saying, oh my God, we knew it was a fad, we knew this wasn't real. But by the way, that happened with the internet as well. I remember in 1998, a Nobel Prize winning economist came out and said, I think we'll see in 5 years or so that the internet had no more impact on the economy than the fax machine. Mm-hmm. Clearly that wasn't the case. And so I would say keep your eye on the big picture, but remember you're going to potentially go through some painful periods in between.
Some very helpful insight and great advice here as we enter what could be a painful time here for some investors. Dan, it's always great to talk to you. Thanks so much for taking the time.
My pleasure, Seana.
That does it for us today for Opening Bid. Thanks so much for listening. We'll see you next time.